Hello, hello, hi everybody. Thank you for coming. Thank you for those of you who came at 12:45 when we said we would get started. I was me who asked that we push it 15 minutes earlier because I am so excited about the book that we're here to launch today. Bruegel's very own Nicolas Véron, who many of you know, who has been with Bruegel since the creation, who has followed many of the Euro area's financial institution building sagas and crisis fighting sagas. He has written a book. It didn't start out as a book. I think it started out as a paper, and it grew, and those of us who read it said, this is great. Keep going, keep going. And now it is a book, and it is available in PDF, and you can get it on our website, bruegel.org, and I hope you will. It talks about the road to the Euro area's banking union and how we got here, going back to the early iterations of the EU and the vulnerabilities that were identified and that were talked about during some of the earlier stages of the treaties, and follows that through to the Euro crisis, which is when I arrived on the scene over here. And we had another round of institution building and another round of confronting the architecture of monetary union. And that got us to, well, I'll let you, Nicola, tell you all about it. But it's great, and you should read it, and I really appreciate you coming, and those of you online, I appreciate your joining us too. I'll introduce our panelists in a minute.
So welcome, Commissioner. Thanks, Rebecca. That was very kind. Thanks to everybody, many are in this room, who made that possible. It's not exactly a book launch because it's a PDF launch at this point, but the book will be printed and be out soon. I will just make a very brief presentation of the book before giving the floor to the Commissioner. Just to say, in a way, the 10-year anniversary is fortuitous because my initial plan was to have the 10-year anniversary in 2022, anniversary of the decision, and then, as usual in this kind of project, writing took some delay, but now we have the anniversary in 2024 for, of course, the entry into force of European banking supervision, the supervision by the ECB. A couple of things just to set the scene, and the book, as is customary, has several chapters, so basically I'll go chapter by chapter. The first thing maybe to say is this is a story of the beyond banking union. This is a story of the EU getting things done. And I think in the current circumstances, it's good to see the EU getting things done. I mean, not everything got done, that's the title, but things got done that actually have, I would dare say, monumental impact. Very impressive achievements. Part of the story of the book is that actually there have been more achievements than meets the eye, even so, of course, there's a lot still to be done. The second thing is it was a long time coming. So if you look at early debates, the aspiration to have particularly European banking supervision has been documented since the 1960s. And it was never, for a long time, it was not really brought into the public domain, so people were not talking about it as, you know, they were talking about, say, the single market program, but people in the supervisory community were viewing it as the horizon of, creating a sustainable architecture for banking in the European communities and union. And revisiting that genealogy and a key episode at the Maastricht Treaty for me was very educational. And then we had the crisis. The crisis, as Rebecca said, was a formative moment with the climax in June, late June 2012. One thing that the book emphasizes is it was a story of collective discovery. So it's not just that, compromises were difficult and kind of, the Juncker story, we know what to do, but we don't know how to do it and get re-elected. It was actually more than that. The real analytical points were discovered along the way. If you think of what nearly broke the Eurozone and which the banking union was designed to address, which is the bank sovereign vicious circle, this is, surprisingly, this is something that hadn't been diagnosed properly in the vast literature in the 1990s about what the Eurozone would not work and would not last long. So think about this. The thing that nearly broke up the Eurozone was not part of the analysis of why the Eurozone would fail. And there were other aspects. I mean, I put a lot of emphasis in the book on the issue of concentrated domestic sovereign exposures in the balance sheet of banks. This was not realized until actually, arguably, pretty late in the crisis, 2010, 2011. It was a heroic fact of the European Banking Authority under Andrea Enria's leadership to force disclosure of those exposures that started happening in 2010. And only when these disclosures were there did people start to realize, and it took them several years actually, how important that issue was. And the crisis was resolved with a moment of decision, which I analyzed at length. I did a lot of interviews to try to get the story correct, with a famous meeting at Charles de Gaulle Airport near Paris and things like that. Cameo appearance of Emmanuel Macron, lots of things to tell, stories. The point I would make here is that essentially the banking union was, Chefsache was a matter for heads of state and government for a brief moment, basically between June and December 2012, in my reading of the story. And then it was given back to the finance ministers, and it would be an exaggeration to say then nothing happened. But I think it is a very good illustration of something we know from European Union matters, that if you don't have a discussion at the leaders level, you're unlikely to overcome the extraordinary obstacles to reform. And I think if you think of Capital Markets Union now, Commissioner, it is actually, I think, encouraging that we're at a moment where the leaders are interested in Capital Markets Union. Whether that will result in the reform we need, time will tell. So then I have an evaluation of the supervisory piece of the banking union, which I view as essentially complete. So that's what is called either single supervisory mechanism or in the book, European banking supervision. They're synonymous. And it's a rare occasion to praise supervisors because supervisors have a difficult job. It's a bit like some other occupations in government. You only hear from them when things go wrong. So thanks to the anniversary, also thanks to the mini crisis in the US last year, whereas European supervisors look good compared with their US counterparts, at this point, European supervisors can get praise, and I think they deserve it. That argument is developed in the book. And then we go to the unfinished business. And here, I think, Commissioner, it's time for the Commission to move on from the famous three-pillar narrative, which was useful for a while, but I think is now counterproductive, you know, supervision, resolution, deposit insurance. No, because now we know that A, resolution and deposit insurance are really one thing. It's one pillar, not two. And B, there's a huge matter outside of that narrative, which is, as I mentioned, concentrated domestic sovereign exposures, and it needs to be brought openly into the debate. The Commission, to my knowledge, has never published a paper about that issue, except saying at some point in 2017, let's kick it into the long grass. I think it's time for the Commission to view the challenge of domestic sovereign exposures as something that needs to be addressed at a similar level as, you know, risk sharing, deposit insurance, and all that stuff, if we want to finish the job. So basically, that's it from me. That's a recommendation. Address sovereign exposures together with the crisis intervention framework, which of course has to include a European deposit insurance, but is broader than just that. Some will say that's too much because you can finish the banking union without addressing sovereign exposures. I disagree. Maybe we'll come back to that in the conversation. Conversely, some others say that's too little because you need a safe asset. I also disagree with that. I think you can finish the job without fiscal union. And let's open the conversation for debate with that. Commissioner, thanks again for being here.
Thank you for that, Nicolas. Let me just introduce our panel. We have a really incredible group to discuss here, the events that have happened and the ones that'll come. We have Vitor Constancio, the former vice president of the ECB. And for those of you who, like me, were following the evolution of this in real time, your speeches, I have to say, were such moments of clarity because you didn't shy away from some of the difficult points that others at your level were cautious about speaking about. You were really clear about the difference between when a bank fails and when a country loses market access, and how from a stability perspective, we need to approach those. And I'm sure hoping you'll share more of your thoughts with that, but I have to personally thank you for the clarity there. We have Martin Véron, to whom we owe the safe asset that we have so far, because as you may know, he has been involved first with the Dutch Finance Ministry and then an illustrious career at the Commission involved in the creation of many of the backstops that have come into play over the crisis, and many of the joint borrowing initiatives we have grew out of mechanisms that you and your committees developed back in the day. And now, of course, you are a Director General in the Commission in DG Reform. And then, of course, needing no introduction, but I will introduce anyway, Commissioner Mairead McGuinness, Commissioner for Financial Services, who has kept the faith on banking union for 5 years and the successive iterations to make it better, to move ahead with the crisis management and deposit insurance proposal and others to help advance on the gains that we have. Commissioner McGuinness is going to give a brief remarks about where we stand and how she sees it. We will hear from Vitor and Martin, and we will have a conversation. Thank you again for being here. I think you have your own microphone.
Thank you. Thank you for the book. Is this microphone on? Yeah, it's really light. I don't hear it. Do you want to check? Okay, I'm going to try. Yeah, I can do both. I can hold a microphone and use an iPad. I actually have a printed copy of the book. It was so riveting, I printed it because I needed to underline things. So well done on the book. It's a great record of things we didn't know or things we might have known, but there are different twists to it. So it's a very important historical record of events. But I think more than that, it points to the future. So I have read all 160 pages. And there are insights there which I wish I'd had at the start of my mandate, but look, it's better late than never. I think what the book does is very clearly set out why the banking union represented such a major step change. Because before banking union, member states were reluctant to move banking supervision away from the national level. And then came 2007 and the great financial crisis, which demonstrated the failure of banking regulation and supervision, with very real impacts on people's lives, as many lost savings and homes and indeed jobs. And just on that point, it strikes me, I've said this on a few public events, that we really need to make banking union relate to citizens in the way that when there's a crisis, it's very real when banking has problems, that people have problems. And I think we failed to do that during the campaigns for the European Parliament. I've just come from Parliament speaking to colleagues. This topic was not on the agenda, and yet it's absolutely pivotal, as is Capital Markets Union. That's my pitch over. So to go back to the problems it caused, the financial crisis for people, also for businesses, bankruptcies, losses, etc. And then we saw how the bank sovereign nexus exacerbated the problem in 2011 and 2012. But as we often do in a crisis, the EU acted very decisively. The twists and turns, and they're intriguing, they're well covered in this book, and I do encourage you to read it, not just summary and conclusions, but all of it. So to sum up, we moved, in your words, Nicolas, from banking nationalism to banking union, and we set up an ambitious system to ensure the stability and integration of the EU's banking system. The banking union exists to avoid history repeating itself. And the aim of banking union to ensure financial stability so that banks can provide funding to the economy, as well as protecting depositors and taxpayers' money. A well-functioning banking union should also underpin a single market for banking. And here's my second grief, if you like. Why do we keep talking about cross-border in a single market? Because I think language matters. And I think we have embedded the words cross-border. I scratched them out of all my speeches, as my colleagues at the end of the room will testify, because I think it impacts in a negative way our thinking about a single market for capital. If we look to what strong banks can deliver, if they're operating across multiple member states, delivering better banking services, more affordable financing to European citizens and companies. And I got one Facebook question in the last 2 days saying, when will we have free banking across Europe, that we'll have more competition? So I live in hope that eventually citizens will push this agenda further as we discuss it here. I also think that in the last few years in particular, Banking Union was joined by Capital Markets Union. So the two projects complement each other. The Capital Markets Union could be facilitated by a more integrated market for banking services. And the CMU needs strong banks that operate across member states to provide key capital market services like listing, trading and investment. So what have we achieved on Banking Union? The single supervisory mechanism set up in 2013. The next year, the single resolution, sorry, that's wrong. Let me just do that again. The single resolution mechanism, apologies, yes, set up in 2013. And the SRB then both have proven their worth and on their own terms. But as you know, Nicola, in demonstrating the EU can introduce radical reforms when required. And I think that's something we need to discuss. Why does it take something radical for us to actually take action, which can be done in a much easier way in times of peace? If I look again to the single supervisory mechanism, it helped the banking system navigate many challenges, like COVID-19, like the consequences of Russia's illegal invasion of Ukraine, and indeed subsequent increases in energy prices and inflation. The most recently, the banking crisis in spring of last year, which hit banks in the US and Switzerland, but not in the EU. But you never know how these things can have an impact. I think clear communication by the SSM, the SRB, and the EBA, all that clarity calmed the markets. The single resolution mechanism provided a way to handle banking crisis, and I think that this, in a way that was unthinkable 15 years ago. It effectively managed two significant bank failures, Banco Popular in 2017 and Sberbank in 2022. So we have made progress on the single rulebook, which underpins the banking union, including the Basel III standards. As you know, we will apply these new standards from January the 1st of 2025. But we do that also looking at level playing field issues. And I recently mentioned that we have taken a decision when it comes to the Fundamental Review of the Trading Book, FRTB, to postpone implementation of this element of the Basel package until the 1st of January 2026. And I can say right now that we will publish that delegated act in July so that we are in a good time and consistent with our decision making. But I also will add that we would expect and hope that our counterparts in the US and elsewhere will implement Basel fully and faithfully. I think it's important with international agreements that we do that. Let me go back then to the subject at hand and see, so what's left to be done? And we've heard already some of that. We do not yet have a complete banking union. We are missing EDIS, the European Deposit Insurance Scheme. We're also missing other elements like a facility for liquidity in resolution. The large liquidity facilities that the US and Swiss authorities quickly put in place in the midst of the banking crisis there of last year showed again how important having something similar would be for the European Union and the banking union. In its statement on the future of the banking union in June of 2022, the Eurogroup agreed to strengthen the common framework for bank crisis management and deposit insurance, the CMDI. The European Parliament made similar calls in its 2022 and 2023 reports on banking union. So, of course, during this mandate, we started by reviewing the CMDI framework. It has worked well in practice, but it doesn't provide appropriate solutions for small and mid-sized banks that are too big to be liquidated. So there are gaps. To resolve these banks, authorities need the right tools to fund the transfer of a failing bank to a healthy bank that's willing to acquire it, while at the same time safeguarding financial stability and avoiding contagion by exempting depositors from having to bear losses where necessary. Now, without such funding, member states resort to using different national tools outside the harmonised resolution framework, including state aid. And this, of course, creates an unlevel playing field. And it means that taxpayers, instead of the banking industry, are on the hook for bank failures. The core of the Commission's CMDI proposal is first to ensure that banks build up sufficient internal capital to absorb losses. And second, to facilitate, with the appropriate safeguards, using deposit guarantee scheme money to close any funding gap for access to the resolution fund. In the Parliament, the rapporteurs managed to reach agreement on the very final day of the legislature, which was welcome. The Council, as you know, recently adopted its negotiating mandate, so we should be able to start trilogue negotiations once the new Parliament is ready. So let me take a look at how things are at this stage of the process. The Parliament's position would make the framework more predictable and effective than it is today. However, in contrast, the Council's negotiating position is frankly very disappointing. It does not deliver on the objectives of the reform proposed by the Commission. I would even say that it does not even deliver on the Eurogroup's own objectives as agreed in its statement. The Eurogroup asked for resolution to apply to more banks, but the Council's position is less ambitious than the Commission on this point. The Council amendments taken alone could lead to the resolution of more banks, but in parallel, the Council does not make it easier to access resolution funding. We counted 19 new safeguards on top of the ones in our proposal that restrict access to funding. And that makes it harder for resolution authorities to know whether the resolution framework could be applied successfully. And this uncertainty would not incentivise them to plan for resolution for many more banks. Instead, they will likely prefer to continue to use national tools. In addition, many of the new restrictions are only for banking union member states. For example, caps on the maximum contribution of their deposit guarantee schemes to resolution financing. In contrast, member states that aren't part of the banking union could use their deposit guarantee schemes in resolution in a much more flexible way. So that will widen the gap between member states in and outside the banking union, and it will reduce the attractiveness of the banking union. So another issue, incentives to use national solutions other than resolution are maintained, or indeed, as I would see it, even strengthened. Our proposal introduced additional conditions for using tools outside resolution, so that tools are chosen based on economic merit, not how easy it is to access funding from outside the failing bank. Almost all of these conditions have been removed in the Council compromise. And this makes national solutions more attractive than the harmonised resolution framework. The Council even goes in the direction of renationalising some aspects of banking union. For example, the SRB plenary session, made up of national resolution authorities, would have a larger say at the expense of its executive board, made up of independent European board members. And that would weaken our single resolution authority, which today is strong and independent. So overall, I believe the Council amendments would not increase financial stability, would not level the playing field, would not improve depositor protection, and would not reduce the use of taxpayers' money. On the contrary, they make the framework even more complex than it is today, and in some aspects, they are a step backwards. The Commission still believes it is important to improve our CMDI framework, and we will actively participate in trialogues with Parliament and Council to ensure that the outcome is a real step forward. And I think this is also important for the future of the banking union. We started with the resolution framework because it was considered the easiest part to fix and to help unlock progress on the unfinished parts of the banking union as agreed by the Eurogroup. Unfortunately, the Council negotiating position suggests member states are approaching this reform primarily from a national perspective, and so failing to consider what's best for the banking union. So banking nationalism has not disappeared, and indeed it may be reinventing itself. So it's something we need to overcome and address if we want to make genuine progress on the banking union. If I look at the European Deposit Insurance Scheme, the EDIS proposal, the Parliament's Econ Committee adopted a report before the elections, and this sets out a first phase for EDIS based on liquidity support between a common deposit insurance fund and national deposit guarantee schemes. It also includes a commitment towards loss sharing in a second phase. And the Parliament report is broadly in line with past ideas from the Commission on how to bring EDIS forward in phases. Of course, the new Parliament will decide how to move forward with this report. And for now, the Commission reserves its position on it. But I will say that after 9 years of stalemate, it is good to see movement. I note the Parliament's report also proposes to take sovereign bond holdings into account in deposit guarantee scheme contributions of banks. If I look to our 2017 communication on the banking union, we indicated that facilitating the diversification of banks' sovereign portfolios and lessening the bank sovereign nexus is important. EDIS is also important because it could pave the way for additional market integration in the banking union, and that will allow capital and liquidity to flow more freely among Europe's banks and allow the economy's competitive and market forces to operate. The words are CB, I'm not saying them, cross-border as opposed to across, I'm not saying them, market forces to operate in the single market. Our big European banks are large compared with the GDP of the member states they're established in, but they're not large compared to the size of the EU economy. Whereas mergers could make banks more resilient to shocks due to greater asset diversification. And they would allow European banks to have more efficient business models, pursue growth strategies, and invest in digitalization. And I'll add what comes with that, cybersecurity, which is always a topic that needs investment. So these banks would be better equipped to compete with their non-European counterparts. At the same time, market integration should always be combined with appropriate safeguards to protect financial stability in all member states. Larger and more diversified global banks would benefit the EU economy. But of course, small and medium banks continue to be essential for local economies, for competition, and so for depositors and consumers. So I know I've been quite clear and indeed quite critical in my remarks, but I'm going to finish on a more optimistic note, because at heart I'm an optimist. I live in hope. I do remain optimistic that the European Union can overcome what are familiar challenges to people in this room, that there are large benefits in the future, but they rely on compromises that are not popular with everyone today. And I'm optimistic because the EU did all of that, reach compromises when it created the banking union, which was a huge step. And I hope that it won't take another crisis for us to meet today's challenges and for us to show the political courage that the founders of the banking union showed. But it's also true, as you remind us in the book, that what remains to be done is not nearly as imaginative as the leap of imagination that leaders took in 2012. I hope we can be reminded of the significant benefits that do await us in the future. Banking union is important for financial stability and protecting depositors and taxpayers' money. But beyond that, it's also important in the current conversation we're having around Europe's resilience and competitiveness. Strong banks can offer better financing conditions to our companies and can support the green and digital transitions. Banking union is also important from a geopolitical point of view. A complete banking union would underpin the economic and monetary union, and so it would strengthen the euro both at home and abroad. It would contribute to our open strategic autonomy agenda. So it is the time now for the next Commission, but above all, the Member States and the Parliament to stay ambitious, to reach that little bit higher than we have seen to date, to deliver the benefits which are needed more urgently today than ever. Thank you.
Thank you very much for that, Commissioner. It's a really good update of the state of play of where we are. And for those of you wondering where the next trench battles are coming, that's a pretty good outline, good signposting. But now we are going to talk about a little bit broader approach of how we got here and what the themes are to keep in mind as we beaver away at some of these things. I'd ask for the panelists to stay seated for the rest of the panel, and audience too. And Vitor, if you could maybe share with us some of your reflections, particularly around this bank sovereign loop and this idea that, what can we let fail? Can we let a bank fail? Can we let a country fail? Can we let the euro fail? You were really dealing with these questions up close and personal for a while.
Well, thank you very much, first of all, for inviting me, particularly Nicolas, to be here, and it's a pleasure to be here. And indeed, of course, the book by Nicolas is a must-read for anyone that wants to know about the banking union and its developments. I can say very little in the few minutes allotted to me, but I praise very much the book about the political economy that was behind the whole project and the way it developed. It's a scholar's book. It also reflects the Nicolas qualities of an investigation capacity of a very meticulous historian, and that's quite important. And we can see that in his description of the famous meeting of ministers and commissioner and IMF MD and officials at the Sheraton Hotel at the Charles de Gaulle Airport just a few days before the summit where banking supervision was approved. And the ups and downs of all the long negotiations and fruitful negotiations about deposit insurance and regulatory treatment of sovereign exposures. All that is very well done, and it's also well done the detailed assessment of the success of the SMS in what regards banking supervision. Well, after all these very deserved praise, this, of course, doesn't exclude a few differences of opinion and a major disagreement with the book. Well, I only highlight one difference of opinion, which is a difference of opinion because it's about the resolution regime, and the major disagreement is about the role of the sovereign bank's feedback loop. So I agree with Nicolas in the book when he writes, and I quote, "The practical implementation of the BRRD SRM legislation so far has presented a mixed picture. The first 8 years of implementation of the BRRD SRM framework in the euro area stand in some contrast to the overall success of European banking supervision." I agree with this, but I have a much harsher view of the regulatory regime and framework of resolution. My opinion is that that framework, it's simply not fit for purpose. And I just highlight three reasons very briefly. The first one is, of course, the famous 8% bail-in clause in the BRRD. We are the only jurisdiction where the quantitative limit was defined. It's very severe because it risks to go into bailing in deposits, which is something that all entities of the same nature try to avoid in order to avoid financial instability. The FDIC in the US never provoked losses in deposits. And that's, sorry? Yes, insured deposits. But no, even in practice, not in deposits in general, because they were used many times, bridge banks or the...
Oh, that's a good point, yeah.
Yeah. So in practice, legally, you are right. In practice, it never happened because they were always able to find a solution of the other tools of resolution in order to avoid deposit losses. So that's a point. And of course, the fact that the BRRD applies to all banks makes it much worse because, of course, smaller banks cannot have access to markets to issue MREL securities, and so if they would be subject to resolution, deposits would have to be bailed in, or in Italy, the famous certificates that the banks transform deposits into securities, selling them as being deposits or as sure as deposits, but they would be bail-in if, for instance, the SRB would have decided in 2017 to apply to the two Veneto banks that were failing the resolution regime, and they were significant banks with balance sheets above 30 billion. The SRB wisely, in my view, refrained to do that, making it explicit that for smaller banks, resolution will never happen. And the CMID will not transform that, already very much watered down by what the Parliament has approved already, and the Council also goes in a bad direction there. And that's the first point. The second point has to do with the fact that the framework totally excludes any intervention of public money during the process, either before I submit or in resolution, because the precautionary intervention is subject to such conditions that defines an empty set. I have no time. And second, because indeed the in resolution, even in a systemic banking crisis, the SRB cannot use the government stabilization tools on national authorities, which means only for small banks. And third, of course, there is the issue of the funding conditions for the resolution. The SRF is subject to very strict conditions and cannot be used for recapitalization or to cover losses and so on and so on. So and there is no liquidity in resolution because the ECB cannot do it without a treasury's guarantee, and that's not happened. So that's my view on that. It's much harsher than the more cautious view of Nicolas. The major disagreement is about the so-called famous doom loop or the feedback loop between sovereigns and banks. Nicolas says in the book, and I quote, that this is the crucial vulnerability of the monetary union. I cannot agree at all with this sentence. In the first place, because it was only material and consequential in the case of Greece, the only case where this was consequential and material. The Irish and Spanish banking crises, which were the second ones which were significant, were not because of sovereign holdings. It was because of excessive credit growth and concentration in bad real estate and housing loans. Nothing to do with those holdings. Second, the home bias is a worldwide phenomenon, and there is a good paper by Hélène Ray and co-authors explaining the reasons why that is so, that the home bias exists. Third, because there are two good papers, one by the ECB, another one by the SRB, showing that if there would be diversification of sovereign holdings within the banks in the euro area, a real diversification, the overall credit risk of the banking sector in the euro area would increase, not decrease. Because supposedly, which was one of the rosy assumptions of many people who intervened in this matter, the rosy assumption that the German banks, when the Italian banks would be prohibited to buy so much Italian sovereign bonds, the German banks would go back and start buying them. And if they did, which they wouldn't, if they did, of course, they would become more risky. So that is from the point of view of credit risk of the whole banking sector of the euro area. And that's why then, indeed, I have this different opinion. And I agree, nevertheless, with what Nicolas says on page 128, and I read, improved banking sector soundness makes most scenarios of a systemic banking crisis, let alone a reactivation of the bank sovereign vicious circle, much more remote than they were a decade ago. The risk that giant holes may be discovered not just in the single bank, but in most banks of a given country, let alone across the euro area, was a perceived menace that was prominent in discourse about risk reduction throughout the 2010s, but it's less plausible now. I fully subscribe to this. But then it was a long-standing focus on this issue of the sovereign exposures, so much so that in the conclusions he could not refrain of writing, and I read again, there is a lingering possibility of a revived bank sovereign vicious circle as existed at the peak of the euro area crisis in 2011-12, remains a fundamental vulnerability of Europe's monetary union. again, I don't agree. The two statements seem a little bit contradictory, but I find it difficult to designate as the fundamental vulnerability of monetary union something that only happened once and to a country. The real fundamental vulnerability of monetary union was and is a macro financial one. It results from the fact that the minimal initial design of monetary union was not prepared to deal with the speed of financial integration that happened after monetary union was created. There were no instruments. And that speed was unexpected. It is also a blind spot in the theory of optimal currency areas, because Peter Cannon and James Ingram were seeing financial integration as a positive element of a monetary union. They never thought that it could be a negative one. And I am about to conclude just to remind that this then was linked with the fact that the credit and capital markets had a huge market failure during that period, because from 1999 to 2000 and end of 2007, the capital markets, the bond market, was treating the risk of all countries as equal. Absolutely equal is an amazing picture if you see all those years. Germany and Greece and Portugal were all equal. And in what regards the credit market, you may be surprised, but I tell you that since 1999 until the end of 2007, the credit lines, the credit by banks in the core countries to banks in the periphery, 5 countries in the periphery, quintupled during those years, quintupled. And at the peak, represented 50% of the GDP of those 5 countries. That created and funded huge overeating and all major imbalances in those countries that were indeed the crucial problem of monetary union. So just to state my view and my major disagreement with the book, which again, I really believe it's a must read for everyone about banking union.
Thank you so much for that. You have put on the table bail-in, state aid, and the role of public money, which I was absolutely and am absolutely going to ask about. And I think you have really identified the tension points. One of the things about this banking union project is that it was so raw when we were going through it. And the fundamental questions are still there and are existential. Martin, we talked about instruments. They've come up in the conversation. You helped create instruments where there were none before, and you have seen where we ended up. What are your reflections?
Good afternoon. I hope it works. Yes. Okay. Well, let me start with a warm congratulations also to Nicolas for putting out this excellent book, which I read last night, and I found very interesting. I liked very much the historic part, and even though I've been part of it to some extent in the past, I still learn new things, and I also relearn things that I had forgotten about. So it was also a bit a trip through memory lane. So thanks a lot for that. Now I share to actually a very large extent the underlying analysis of Nicolas, and that pertains in particular to the nature of the what I and he would call the euro crisis rather than the sovereign debt crisis. I think what bound us already at that time, that we tended to look at this crisis more through a financial prisma rather than purely through the sovereign lens, and maybe use this point also to react to Vita's point, even though I'm pretty sure that Nicolas will do it as well. I have a slightly different interpretation of this doom loop now, and I don't want to speak for Nicolas. I do think that this doom loop played a very important role, but I have a rather simplistic version of it, and that goes like this. What one could observe were that concerns about the health of the financial sector spilled over in concerns on the sovereign and vice versa, and that had liquidity implication both for the banks and both for the sovereign. So I would not say that is only related to the holdings of sovereign bonds by banks. It's a broad, for me it's a broader concept, which I do think, at least from my perspective, recollection did play a rather big role in the crisis. Now, the other point that I very much share is the incompatibility of national banking supervision with a common currency. Now, that was something that I had believed that I had held for a very long time, even predating the Euro crisis. But it became very tangible to me in the course of 2011 when a Dutch banker told me that they were actually instructed by the supervisor to match assets and liabilities at the national level. And then I realized, okay, but if this is the process that we're in, we are actually in big trouble, because it simply means that debtor countries, but net debt in the broad sense, not just government debt sense, that they will be in trouble, and they were actually in trouble, because it would. I also agree very much, and I don't need to elaborate on that progress has been very uneven, largely a success on banking supervision. Now one can debate on whether on the resolution, whether it's mixed picture, Nicolas, or whether it's a negative picture, Vitor. But clearly progress has been much less in that domain. And I've not been involved for the past 10 years anymore in this field. This is really for colleagues of DG FISMA more than for DG ECFIN. But I've seen the struggle, and I thank the commissioner for a very clear account of the problems which I can see and recognize from discussion. Now, so the question then indeed becomes what to do about it, because it's not for lack of trying. I think the Commission has tried whatever it could, but without the pressure of the markets, it's simply very difficult to make progress. So that leaves me. That leads me to the following thought, but under the clear proviso that I'm not responsible for it. It's not an official Commission position, and I'm not the best informed. So a lot of provisos. But I thought maybe we should flip it around for in the next mandate and start essentially with the money. And what we have today, and which we didn't have 10 years ago, is 80 billion in the resolution fund. And maybe the question that we should ask ourselves is, okay, how can we put this money to the best use, and where do we get the biggest bang from this money? Now, here I would very much agree with Vitor that if you look at all the conditions that are put around this fund, it's very hard to see how this fund is actually going to be how this fund is going to be used. I think the main idea is to use it for some form of capital support, but that's after a lot of bail-in and while realizing that the DGS is still national, so that comes also first. So the question is, okay, what is left after that? And well, whether the set is completely empty, I don't know, but it will not be huge. At the same time, and also Vitor mentioned that we still haven't solved the issue of the liquidity in resolution. And I would argue that probably, certainly in a world where at least part, if not all, of the losses are allocated to creditors of the banks, the funding in resolution may actually be the bigger issue than actually the capital support. So maybe one avenue to explore is to say, look, we have 80 billion. Liquidity in resolution, that is typically, it's large amount, but relatively limited expected losses on it, because banks have gone through resolution already. The credit losses have been allocated in one way or the other. So one idea is then to take this 80 billion and enter into a discussion with the ECB. So if we have this 80 billion, what can you do to help us with this resolution or liquidity in resolution? And maybe this could be a way to by approaching it from a slightly different angle, to make some progress in the file. But this is just a thought, purely personal basis, and well, I thought I had to offer something for today. So.
I appreciate your bringing those thoughts out, because you can really see the Rubik's Cube, where a system was built with money in it, but it was made very difficult to use. There is money needed for various things, and there remains this divide between the financial stability people, usually the central bankers, and the politicians about, do you use it and how? I remember certain German politicians saying very clearly that this or that instrument was not there to be used. It was said expressly. And that is a less useful system than one that you do use. Nicolas, where do you see the role of government intervention? And do you think we've gotten into a system where, because it's so hard to get money through the system, people just skip the system and provide money where they see it needed?
Yeah, well, that's what we have now, and it's not sustainable, because that perpetuates the bank sovereign vicious circle, which is the vulnerability of the Eurozone. I want, before going into a little bit of discussion, and I will be brief, I want to thank all three other panelists. Also, I want to thank the commissioner first, because Commissioner, you're the commissioner, and I'm very honored. But also Vitor and Martin have had a very personal role in the story I tell in the book. And Martin just showed us how creative he can be with financial engineering, and he has been a problem solver time and again for the European Union. He's very soft-spoken, he's discreet. People don't know about him, but he's been the hero of a lot of those stories. So thank you, Martin, for that. But also thank you for banking union, the expression, because one story I tell in the book is that in 2011 I was using the expression banking federalism in my advocacy and stuff, and it was Martin who told me, I was at this meeting the other day, I heard somebody talk about banking union, you should use that. And I believe, for lack of alternative evidence, that after that, of course, I shifted to talking about banking union, and then it was adopted by others. And it looks like this was the introduction of the expression banking union in the public debate. So we still don't know who coined it, and I think we don't remember, but it was you who introduced it into the circuit. So thank you for that too. Vitor, I think it has to be said again and again, he was in charge of financial stability at the ECB when all this happened. He was the architect of European banking supervision. Of course, it was a collective effort. You were serving under Mario Draghi, there was Peter Pratt, Benoît Cœuré, others, and there was staff, Ignazio Angeloni, Pedro Gustavo Teixeira, many others. But I think one thing that makes me particularly happy is that you could make it today for this event, both of you, is your respective roles, and particularly, again, in this incredible success of banking supervision, the fact that it was designed so well owes a lot to you personally, Vitor, and I think all Europeans owe you gratitude for that. So I'm not coming back to our difference. I think that's pretty clear. We have that conversation. We have had it for several years. I will say about CMDI, echoing the commissioner's remarks, that unfortunately this failure, if that's the right word, was predicted. And in the book I quote the senior official of DG FISMA, John Berrigan, who said, a few days after the mandate was given by the Eurogroup to work on CMDI, but without making it a European deposit insurance, he said, you know, we will work on it, we will make a proposal, which they did, but without European deposit insurance, we will quickly realize that something important is missing to make it work. So I think that's where we are. I mentioned the fact that banking union was Chefsache, was leaders level only in 2012. My view is that it will need to become leaders level matter again for progress to be made. And the lesson is, as long as you leave it to finance ministers or the lower levels, it doesn't make progress because it's difficult to, you know, forge an agreement with all the resistances and the different points of view that we have. I want to say, however, to conclude this point, that you really have to travel outside of Europe to realize how respected your respective creations, the European banking supervision, the SSM, is how respected it is internationally. It didn't exist 10 years ago. Now it's not only up and running, it is a reference point for the world. And if you look at, for example, what the World Bank, I think there are people from the World Bank in the room, how the World Bank gives advice to countries outside of Europe on how to organize their supervision, what kind of supervisory review process to adopt, standards, practices. So SSM has become a major reference in the world. And I think there are, I mean, you can call it the Brussels effect. It's a big achievement that has to be recognized.
So we have only 15 minutes for Q&A. So before I call on anyone, just keep it to a question, not a comment, please. And panelists, to the extent you can keep your remarks concise, we can get in more answers. Nick Reinhardt, thank you for coming.
Yes, very quick. Nicolas Reinhardt for Consulting. Yes, you said that banking union was there primarily for financial stability, but it's also there for competitiveness. And if we look at what happened in the banking market in the last 10, 12 years, what has happened? A retrenchment back into the home markets. We've not really seen an increase in mergers. And finally, we've seen abdication of investment banking, key for capital markets union. So what does it take for banking union to actually see the banking market move in Europe?
It's a great question, and we also have one from Slido, thank you, question submitters, asking, do the banking rules, how do they affect competitiveness with US and Asian banks? Commissioner, you, I'm sure, have given much thought to competitiveness. Where do you see us?
Well, actually, I came here to take notes, and I've taken great notes of what the panelists have said, because we need to translate the wisdom, both of the book and the comments, into how we actually make progress. And to your point, I would say that in my experience, and I wasn't involved in the financial sector until I was appointed in this role, we have more national views of banking. If you listen to debates in national parliaments, it's about keeping our banks status quo, no change. That does not sit well with the vision at all. So we need to really make the conversation more real in the member states. My second point is around the role of leaders. Absolutely crucial that leaders take this issue. Having said that, the leaders have said very strong things on capital markets union, but when I listen to my finance ministers, they clearly didn't get the memo because they're not quite responding in the way that the leader's statement would suggest they do. Maybe that will change with a new commission, and I think the word competitiveness is the key here. We've moved from grand ideas, Green Deal, into how do we finance it. The money required is enormous, the public purse is limited, so we need private investment. One of the things I pushed for was to try and have a more retail investment culture. I didn't make the progress I should have on this, and I'm not pleased about that, and I will leave a memo for who will take over, because we won't have capital markets, and we need to mobilize these deposits. To the point of the question about competitiveness in our banking system, so I get a lot of complaints from banks that they're not competitive relative to global players, which is why in one sense we've addressed the Basel III implementation, that we want to make sure that our banks are not put at a disadvantage on implementation. So on the fundamental review of the trading book, we've moved. But I also think it's interesting that the SSM is regarded as a reference point globally. So the Brussels effect is welcome, but our banks are concerned about the fact that they feel at a competitive disadvantage. But I think the root of all of this is in the member states and in citizens. We have no democratic push for movements in this area yet. And I think without that, completing banking union and capital markets union will always run into difficulties. Having said that, when I read the details of how these mechanisms were put in place, frankly, it was not done in the public space. It was amongst deep thinkers who saw solutions to problems that loomed large. And therefore, my point, and I think others would share this, around waiting for something bad to happen before we move, that's not a solution at this point. And that's why I would say that for the incoming commission, and I've just come from the parliament, I've had discussions on lots of topics with new and older parliamentarians, that the competitiveness agenda has now got to be matched by action. And money talks, and money will matter if we are not only politically to make Europe stronger, because remember there are cohorts in society who today are questioning the whole approach around a Green Deal because they feel that it's not for them, that they will carry the cost, that there's no, if you like, signal about where the investment comes from. So I think politically, economically, the discussion has to be pretty raw. And therefore I think your book and the disagreements it has given rise to is a really good basis for a debate in the Parliament. And I would hope that we can have this debate with parliamentarians because even with the best will in the world of leaders' statements, if they don't communicate with their finance ministers, and sometimes they don't, then we have a big block in the system. And I'll give you an example of where even finance ministers don't communicate with justice ministers. So we have an insolvency proposal, quite a modest one, to try and harmonise some areas of insolvency law. And it's stuck because obviously justice ministers have a different view. So I suppose, in essence, we need more Europe. So we need those words, those nice words of support for these initiatives to be matched by decisive action, and that there's joined up thinking, including in committees in the European Parliament, but particularly amongst cabinet members of the 27 governments that sit. Because I have been really struck by what I hear from the leaders and what I experience inside ECOFIN. I mean, I had this last week on Friday in Luxembourg. So I think we just have to keep edging forward. And I would think that this book provides a very strong basis. I mean, the heading of chapter 6, do we procrastinate or do we anticipate? And I think we just can't sit around sitting on our hands. I would have thought that COVID, this horrible war that's ongoing on European soil in Ukraine, the impact of our vulnerability on energy, the need to invest. I mean, we can't just sit in our hands. We have to actually move, and we need to move the money.
Excellent answer. Martin, competitiveness, and how does this sit with the idea that we need a bank failure regime?
No, well, just one thought on it. Well, maybe two. The first one, I do see a link also with the backstop, and certainly in the crisis was said a lot. Okay, banks are international in life; they are national in debt. Now, as long as we keep that system, I think that will constrain the banking sector in Europe. So that is one part. The second comment is I would be a bit I'm sensitive to the competitiveness argument, and certainly for competitiveness of Europe we need a strong banking sector and a more developed capital markets union. But I also remember the discussions that were there in 2006 and 2007, where pretty much the same arguments were launched. As look, we need to lower our supervisory standards, and that was within Europe, because, and I remember the discussion in the Dutch Ministry of Finance at the time, because otherwise everything will move to Luxembourg was our concern at that point in time. So we and we need to be very careful not to end up in that process again.
Tara, what do you think would be a good way to manage government or institutional support to failing banks? We've talked about a lot of systems that have not worked, but is there one? Martin suggested maybe putting the 80 billion to work. Do you have a suggestion for facilitating either precautionary aid or using the deposit or resolution systems? No, you're shaking your head. What do you think?
No, I don't have any particular, panacea to that. I want just to change the legislation that exists on those points, both the precautionary strict conditions and also Articles 56 to 58 of the BRRD, which are only to be applied by national authorities and not by the SRB. But the competitiveness issue, I would like also to say
Please, yes.
something about that, because one sort of implicit objective of banking union was indeed to foster a complete change in the integration of the banking sector in the euro area, and that did not progress. Why? Well, in the first place, because the legislation as it exists creates the possibility of the so-called discretions and exemptions, which means that in what regards the pan-European management of capital, liquidity, and collateral, which big banks would like to have, doesn't exist because the smaller countries have the possibility and have exerted that power to ring-fence at the national territory some of these things, both liquidity, capital, and collateral. And that exists. Why? Because the small countries are in panic to the idea that a big banking group in Europe would have a crisis and of course would leave behind what they had in smaller countries, and the smaller countries all of a sudden would be without a banking sector. That's the panic. And both the exemptions and discretions are there in the law, and no mechanisms were created to reassure the smaller countries about that. So there is a total deadlock in that respect, and that hampers, of course, the possibility of mergers, of banks going cross-border, and all of that. There is a concept in the BRRD, which is the group financial assurance, support assurance, but they are not mandatory and they are not enforceable, these GFSAs. They should be made mandatory and enforceable because that would create some reassurances to the small countries, but they are not. So they are useless as they stand in the BRRD. But beyond all these that I said, supposing that there were no discretion and the exemptions and all that, which are really obstacles, real obstacles, the fact that in the last 10 years there were no cross-border movements or mergers and so on, it was because the sector was not profitable enough. There were no profitability conditions either at home or to motivate the big banks to go into other countries. And that was an overwhelming situation. That is changing now in the new environment, but of course, all the other legal obstacles that I mentioned will be there, and so nothing material will change if these points are not addressed. These are the issues about competitiveness.
So we are coming to the close of our panel. I would love to talk about this all day because that's the kind of person I am. We've heard, though, the great achievement of putting together the supervisory framework.
Allow me 5 seconds.
5.
To say that, of course, I accept that the feedback loop sovereign banks is a vulnerability. but it's not the fundamental, the crucial.
Yes, we have discussed that at length, and in my wrap-up remarks, I was just going to say there is a debate over the doom loop. There is a huge accomplishment over the supervision, and we have these open questions of state aid, can you use the money, home host, and what is our single market? And with that, Nicolas, I give you the floor to speak for about 5 minutes and just help us make sense of all this and encourage people to read your book, which you can download on our website.
Yeah, 3 minutes because we want to finish on time. Three things really. First, I didn't really answer your previous question, Rebecca, which was about the crisis intervention framework and the national propensity to use taxpayers' money. I think it's actually pretty simple. As long as part of the intervention framework is at the national level, that will dominate. So basically what is needed is to transfer the full authority over bank crisis management and resolution to the European level. And I argue that you cannot do that if you don't at the same time address concentrated sovereign exposures. That's our discussion. And only then will you have a complete banking union, but that's achievable. Second point is about the time scale. I know that everybody who has spent hours and days and weeks and years negotiating about deposit insurance and resolution and all that in the last 8 years is very frustrated about it. There has been this feeling of nothing making progress. But 10 years is not a very long time for a project of structural transformation. So we're only at the beginning of this major watershed event of mid-2012 having its consequences unfold, and I expect much more transformation going forward. Last point, leadership. The story of 2012 is the story of leadership, and there were many people who displayed leadership. One of the heroes of that, I didn't mention him, but I should, is your predecessor, Commissioner Michel Barnier, who couldn't make it today, but was also one of the people who really made it happen. We need that leadership. So the choice of the next Commissioner for Financial Services will be very consequential for everything we're talking about today.
Please read Nicolas' book. When you come back in September, you can come to the Bruegel annual meetings and hear about the recommendations to this next Commissioner for Financial Services and read the forthcoming memo about what happens next. We appreciate it. As always, you can find the recordings of our events, our reports, Nicolas' book on bruegel.org. Thanks for coming.